Hi, everyone, and welcome to Stock Market Today. Ali Corman, Justin Nielsen here with a look at what went down in today's session. And Justin, it seemed like a pretty terrible, awful, no good, very bad day on Wall Street. We did finish off the lows a little bit, but it was pretty ugly out there.
Yeah, when you say what went down, it was pretty much everything. So we'll take a look at Danaos in the shipping, and we'll take a look at InMode, which was already looking a little problematic. But energy was the one thing that was kind of the bright spot. So we'll take a look at PXD, Pioneer Natural Resources, and discuss whether or not that's a good idea right now.
Yeah, we will. Let's take a look at the major indexes. Here is the NASDAQ closing the day down 2.1%. The S&P 500 down 1.3%. The Russell 2000 down 1%. And the Dow down just shy of 1%. So we did finish a little bit off of the lows here, Justin, but that upside reversal on Friday did not signal the bottom, at least as of yet.
Right. Yeah. So it's a little consolation when you finish off the lows, but still down quite a bit. So again, what you have to really kind of keep in mind is put this in the perspective of what we saw last week. And that was just very persistent and consistent selling. So when you get distribution days, one right after another consecutively, you look at that volume that was increasing every single day on the selling. That's something that usually does signal bad things happening. And that was on top of already heavy distribution, a lot of stalling action a few weeks ago. So, that combination, this is the reason why we've been a little bit more hesitant to get involved with this market, why we've been talking a lot about defense. And again, sure, you can have a rally day every now and then, but we really look for a follow-through day, which can't happen until 4 days after a rally day. So that rally day on Friday, look, you have to just treat it, a little bit suspicious until you get the confirmation. That's what the follow-through day is. And so right now, there's very little reason to be, super aggressive in this market. Don't try and think that I'm going to, come in and find the bottom and buy at the bottom. This is one where you have to be very careful because even those things that have been holding up semi-okay, a lot of those were getting hit today. So it just feels like nothing's safe out there.
Okay, and taking a look at the S&P 500, finishing off lows, but still intraday undercutting Friday's low. So it's not as much as we saw the NASDAQ undercutting, but still
not looking good.
Still not looking good.
And this was one of the reasons why we were a little hesitant at first to go to market in correction, was because the S&P 500 and the Dow Jones Industrial Average, were holding above their Friday lows very well. But, again, what happened here was you were trading below the 50-day moving average line on the S&P 500. You got up to the 50-day moving average line, got turned away. That was kind of another chance to maybe back away a little bit. So when things start going south, you will have those rallies, and those are often the gifts to you, giving you that next chance to get out before things get even worse.
And a quick look at the Dow as well, see where it finished today. So it's still holding above the low of the 20th of September, but not looking great by any means. IWM here tracking the Russell 2000, trying to once again find support at the 200-day line, an area where it's been able to hold roughly around, but not out of the woods by any means.
Right. And again, what we've been mentioning on IBD Live a lot is, look, even though the indexes were being propped up by the big $1 trillion club, Apple, Amazon, Microsoft, and those guys, look, now those guys are getting into trouble. They're looking a little bit worse for wear. And what we were seeing underneath the surface, we've been talking about the advanced decline line, not really confirming strength. There's also the number of stocks that are above or below their 50-day moving average line or 200-day moving average line. There really has been a correction taking hold in individual stocks here for a while. It's just that now the indexes are kind of showing it.
And growth stocks in particular, Justin.
Absolutely. Whether you look at FFTY, which, does seem to be getting support at its 200-day moving average line for now. But again, growth has been getting hit hard. We just got to new highs a couple of weeks ago, which, felt great at the time, but was very short-lived. So you can't necessarily say, okay, well, I'm going to just, keep on thinking that growth is where it's at. And again, long term, when you're in a diversified ETF, look, that's fine. You can be holding on to that, but you have to know that a correction is going to probably hit growth a little bit harder than the indexes. And so as long as you're prepared for that, and some people, look, when you're dealing with ETFs, you can even buy more as it's coming down. But you have to make sure that you're not at a level where the pain threshold is going to get too heavy and you're going to sell at the bottom. And just on the growth side, we can also take a look at ARKK because that's another one that we've been using as a proxy for growth. And you can see that that one has been having trouble even getting above its 200-day moving average line, above its 50-day moving average line. It's been in a serious downtrend for a while.
Mm-hmm. It has. And shipping stocks were looking pretty good until today.
Mm-hmm.
But DAC falling hard, down about 13.4% for the day. So seems like now a bit of a broken stock at this point. I mean, it was a pretty clear sell signal today. I guess it could build a base from here, but not a stock that we want to be holding with this sharp decline slicing below the 50-day.
I would much rather buy a stock after it's based than try and sit through the base because who knows how bad this could get. And look, I thought that the action before was, fairly decent. The fact that it had gotten support at its 50-day moving average line, it bounced
Right.
from there and was looking strong. That's great. But I think the lesson here is that, no matter what you are, no matter what stock you are, a lot of times that market influence is going to turn the tide against you. And that certainly happened in the shipping stocks today.
Mm-hmm. But Justin, it has an RS rating of 99 and a composite rating of 98. That means this is a good stock.
Well, that means it's a stock. It's a stock with good ratings. That doesn't necessarily mean it's a good stock. And the relative
Mm-hmm.
strength rating is going to be very slow to change on this one. If you look at the relative strength line, that's telling you where it is in relation to the S&P 500. You see that that's in a downtrend, but that relative strength rating, that's going to be taking into consideration where it is relative to 12 months ago. And relative to 12 months ago, this has to come down a lot before you
Mm-hmm.
start getting into negative territory. So you don't want to give up all those gains, and you don't want to wait for this to get weak. This is showing you early signs that there's a problem. The market is showing you signs that there's a problem. So this is just you want to be backing away and not
Mm-hmm.
getting hurt. I think that's the big
Yes.
thing.
Yep.
Not getting hurt, defense. That's where it's at today.
Mm-hmm. Wait for sunnier skies.
Hmm.
And InMode, INMD, having a hard time today, also down 13%. Heavy volume again. This is a stock that was a really great trade up
Hmm.
until a couple of weeks ago, but now closing below the 21-day line here and continuing some pretty sharp declines.
Yeah, and I own this one. I sold this into strength, and I sold way too early. I was selling this when it was looking, climactic to me, and I watched this thing go up another 20, 20, 30 points. Well, I guess not after the split. So a lot of people were talking about the split, and oh, what does that mean for the stock? Well, the split doesn't necessarily mean too much for the stock. What I was going off of was the climactic action. After already making a big move. And if we go to the weekly, we can see that this had a very strong move already, and then it started really changing the angle of its ascent. And that kind of action is a warning sign. And look, you're not going to necessarily get it at the top, but that's okay. If you can get
Mhm.
within 10%, you're doing
Yes.
great. That's awesome. And going back to the daily, a lot of people might have been looking and saying, well, gosh, it held up okay. It came off the bottom. Our final sell on leaderboard was on that second down day, and the way we looked at it was when it bounced like that, we looked at that as a gift, like, oh, this is a chance for us to get out of this before things turn and
Mhm.
potentially get us more hurt. So that way we took a lot of gains off of this, and we didn't wait for this to have all those gains disappear. And so, look, it could come back, but generally after climax tops, you get a lot more weakness that follows. So you got to be careful with that.
Yeah, so a great example of taking that first profit into strength
Mm-hmm.
Also the climactic action, and then a sharp slice below the 10-day line. You don't have to wait for that decisive close below the 10-week line.
Right, especially when you start getting very extended from the 50-day moving average line. If you go to the top, the top blue day and just kind of hover over that, you were 42% extended above the 50-day moving average line. So if you were waiting for this to cross below the 50-day moving average line as your sell signal, that's a lot to give up. So I'd much rather sell into that strength. And look, if you want to hold on to a little piece, okay, fine. But again, in my experience, when you get that climactic action, they're usually done for a while.
Yeah. Yes, we want to be studying past history and helping that inform our decisions. The more data points that we had to base our decisions off of, the better. That's what we want to be doing. And let's take a look now at PXD in the oil and gas group, breaking out today, which on the face of it seems like a really great thing, Justin. But this group has been moving for a while. So is it really too late to be getting into something like this?
Yeah, that's the trick here. And again, you might be looking at the oil stocks and saying, well, okay, they are bucking the trend, and that, I mean, they certainly did today. I mean, this was up 2.5%, whereas the Nasdaq and the S&P 500 were down 1.5% and 2%. So that's certainly bucking the trend, but I'd also suggest that this was a little bit extended already. Really, kind of the buy area that I would have preferred is as this was getting above that downtrend that you drew, which also corresponded to, like, if you just look at that 160 level, and if you just draw the line straight across, there seemed to be a lot of resistance at that level from previous times. So that seemed to be an important level. When it got above that, I think that was a better entry for this one. And we're up 20% from there at this point. So that feels extended to me. And you also brought up another point. There's a lot of other stocks that have already been in new highs. You look at Devon Energy, DVN, that one, that's been looking much stronger. Antero Resources, AR, that was up a lot today, gave back some of the gains, but that's been in new high ground for a lot of weeks. So the fact that PXD is just breaking out now does make it seem like it's a little bit late to this party, and you got to wonder, is that going to be the one that's stuck with cleanup? And I also I have to confess, look, I saw the energy stocks looking strong. It just so happened I picked the wrong one. I picked Denbury, and that one just wasn't going anywhere. DEN. So sometimes you put your money on the wrong horse, and you have to make the decision fairly quickly. Hey, am I going to switch it to something else because this one's not working, or am I just going to sit out this move? And for me, I just ended up sitting out this move for the most part.
So I think a lot of investors out there are wondering, with a number of these energy stocks still looking really well, not acting like there's any correction whatsoever, is this just isolated to tech? Going back to March of this year, where we saw that rotation really rear its head, and we started focusing a lot more on those cyclical names. Is that what we need to be doing now, or are the circumstances different at this point?
Well, sometimes what I'll do is I will look at the sector funds to kind of get a sense of, are there pockets of strength elsewhere? And certainly energy did stick out, but you also had, the financials, the materials, the industrials, the healthcare, they, some of those things weren't down as much. The XLF, which is the financials, that was down less than 1%, but still 0.9%. It wasn't a great day for financials in general. Even your, industrials, those were down 0.5%. So the issue is that, when you start seeing those indexes roll over, and while the Dow Jones Industrial Average was a little bit stronger, the Russell 2000 was a little bit stronger than the S&P 500 or the Nasdaq, you just have to worry, is that tide rolling over going to eventually end up knocking more stocks down? And are you feeling like you're going to be lucky enough to get the ones that are bucking that trend? My philosophy is I'd rather sit on my hands for a little while and get back in when growth is in favor, when my style is in favor of investing, rather than trying to switch and buy in a market where things are potentially going to go against me very quickly, because you might find that you can pick some of the winners, but the chances are you're going to be picking so many more losers. It's overall you're going to lose. So I just would rather sit on my hands during that time period.
Yeah. Well, Justin, we could potentially be only 4 days away from a new uptrend, but we'll have to see.
Yeah, and that's one of the things that I learned from Bill O'Neill. Just no matter how bad things ever got, he was always optimistic that, hey, this is building the opportunities. These are the bases that are forming right now that could bring you those opportunities for the future. And he always stuck with his routine, checking on the stocks that were holding up the best, checking on the ones that looked like they weren't, participating in the downdraft, so that if they did base, and we got that follow through day, as you mentioned, that could be just 4 days away. He was ready with a whole list of stocks with strong relative strength that he was ready to go after.
Mm-hmm. And Justin, remember how we were on that really long streak for the S&P? What was it, over 200 something days without a 5% correction?
That ended Thursday.
So that ended Thursday.
227 days is what we got, and that's over now.
Mm-hmm. All right. Well, we'll have to see what tomorrow brings us. John Najarian. We know that's what tomorrow will bring us on IBD Live. So make sure you tune in for some great insights with that option extraordinaire that John Najarian is. We're looking forward to having him on investors.com/IBD Live. We'll also have our leaderboard scorecard. Since it is the beginning of the month, we'll be talking about the last month of trade, what went down in September. So if you are a subscriber or a trialist, make sure you join that webinar tomorrow after the close. You'll see the banner, a link in the banner at Leaderboard to be able to join that. We'll see you then, and we'll see you right back here tomorrow after the close. Thanks for watching.